is there a change in appetite and attitude of capital to the transition as well? Because I'm beginning to see some of the biggest money managers on the planet just backing off a little bit on their ESG commitments.
Well, here's what happens. If you're in the money management for a business, you do need returns. And we've seen that. We've seen it, I think, more with North American funds, that yes, we want to do energy transition, we want to do ESG, but we actually need returns as well. And that has shifted the attitude. There's a kind of more realism. So there's a lot of capital available. I mean, the IRA, in terms of scale of money being poured in, there's nothing to compare it to. But I think you see that. Second thing is cost of capital goes up. That's affecting renewables. And thirdly, you look at what's happening in terms of costs and supply chains. Offshore wind now is about 40%. Everybody's talking about 40% increases in cost. And you see projects being slowed down or paused, or let's redesign our supply chain. So there is you're quite right. There's technology and then there's a realism of money.
Dan, just quickly, how are you assessing the structure of the oil market as we come into the fourth quarter? The third quarter was pretty good. I want your take on whether or not you think OPEC is going to keep these cuts in place through 2024, or is an unwind coming?
Well, I think that, I think one of the main goals of OPEC Plus was to keep inventories down. Boy, you look at Cushing, Oklahoma, where the tanks are really low. The markets are really tight. But you have the question on the other side is, what's the strength of economic activity, the degree which China is going to come back. So, I mean, we're going to bounce up and back across. Are we going to get to 100 or not is going to be a discussion. But it's a fundamentally tight market. And with the Russians putting restrictions on the exports of diesel and other fuel, that just adds to the tightness in the market.
Again, I dare to do this, but I'm going to challenge the great Dan Yergin. It's only a fundamentally tight market, Dan, because the Saudis and the Russians have led 5 million barrels to be taken off the table.
Well, that's true. That is a tight market. Yeah. If you put it back, it's no longer tight.
Fundamentally, because they've made a very conscious decision to take that away rather than they're not having the capacity as well. What happens if there is a global recession or so? Because at the moment, Chinese demand, way more robust than people thought as well. Global demand, way more robust. But let's say that some of the consumers do experience a recession as well. The US has a slowdown a little bit more than some people are talking about in the current Goldilocks scenario. Can they hold the prices up at this level?
Well, I think it becomes much harder. I mean, I always say, when people say what's going to happen to oil price, my first question is what's going to happen to GDP. So I think you put your finger on it. And it's quite true that this is not a demand-driven tightness in the market. This is a supply-driven tightness.